Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding Podcast, sitting next to my co-founder, Geoff Gannon. Geoff, how's it going today?
It's going very well. How's it going with you, Andrew?
It's going really well as well. We hope it's going great for everybody else. If this is the first time you are tuning in with us, be sure to check out all of our work. We blog about ideas at focuscompounding.com. Geoff has a plan of writing up 250 plus ideas for 2020. I'm not going to stop saying it.
Okay.
So be sure to sign up. And if you do sign up, use the podcast promo code, which will take the $10 off the $60 subscription price. So bring it to $50 a month. And that promo code is the word podcast. We are going to be putting up a ton of YouTube videos this year. So make sure you hit that subscribe button and thumbs this video up. And be sure to follow along if that's how you're watching us right now. And of course, the backbone of everything is the podcast and the Podbean app. So if you're listening to us there, we're happy that you are listening to us. Be sure to leave us a rating and review. That helps spread the word. And I guess final is at Focus Compound. That's the best way to get all the information from us. At Focus Compound on Twitter. I constantly tweet out a bunch of different things. So be sure to definitely check us out there. Okay. Now that is over, let's talk about the topic today, which is how to avoid value traps and melting ice cubes. Melting ice cube is really this term that's pretty popular in the value investing community on, a company like Kodak, for example, that looks cheap at 5 times earnings, and then it turns out that, it was actually very expensive, right? So from your experience of looking at a bunch of different companies over the past, 20 years, what do you think you can do to really avoid, value traps or investing in melting ice cubes?
So the first thing is just look for revenue growth. I mean, the easiest thing is just that the company continually grows revenue a little bit. Okay. So that it has any revenue growth at all would be helpful. And the second thing would be that it's consistently profitable and not just free cash flow generative, but also it does have profits on a regular basis too, both of those.
And that's one of the screens that we actually run, not the revenue, but that they've been consistently profitable for 10 plus years.
Yeah. I'd say we don't it's hard for me to think of cases where we invest in companies that have consistently shrinking revenue or something, anything like that. Even when people like, we own NACO, which is a company involved mostly in coal mining. Even something like that where people would say, it's a melting ice cube or whatever those things are like that. It hasn't shown up as having declining numbers in terms of revenues or declining numbers in terms of actual tons of coal mined each year or something. Those numbers have grown over time. Now, that doesn't mean that you're getting in so early that eventually those things will decline, which is always the question. But what I'm telling you now is that at least you can avoid getting into something that's already having declining numbers in those ways, right? So the other thing for me, generally, that's the big one is avoiding stocks that have meaningful competition. So the easiest thing, the thing in which a company can quickly decline.
Competition is the root of all evil.
Yeah. The way that it can quickly decline, it has to do with competition. So if it has heavy competition, then the decline can be really fast versus even if it's in an industry that's not going to have a lot of demand for its product over time. If it's one of the last ones in it, and if it's not a very competitive industry, then it's you're gonna have a lot more preservation of value for a lot longer than you'd expect. So you'd be surprised by that. Whereas if you're in some sort of retailing thing or something, so like you say you're in retail or something, and like a retailer that's a value trap or a melting ice cube or something is very scary in a way that other sorts of businesses aren't. A services company it would generally not be as worrying that way.
Do you think you would know a lot sooner if you made the mistake on the service business as opposed to the real estate? Because I think a lot of people, or like retail or whatever, or people that invest in malls, for example, like Sears or whatever, what were a lot of people banking on? They were banking on the actual real estate and stuff as well.
Yeah, that's true. Yeah. And so that's another good example, which is that if that's what you're counting on, then you have to look at what that value is, and you sort of have to do an appraisal all the time of it. One thing that would worry me is if you're doing an appraisal of a company constantly and your valuing of it goes down over time. So now you have to be realistic about that. It seems that once people own a stock, their appraisal of it doesn't go down over time.
Change, no.
You know, if they buy a stock, it doesn't go that, they buy a stock at $40 thinking that it's worth 90. They don't say their appraisal doesn't usually go to it's worth 80 or something when the stock goes down or when it goes up, But that's another part of it, which would be if you're getting rid of the stuff that you think is valuable. So that's a concerning thing about it would be like in the case of like a Sears or something like that. If your case was based on the real estate, then you'd be worried about anything that disposes of the real estate, right? So that would be the big concern. Generally, having very strong solvency, so having a very strong ability to finance yourself with cash, is a big help. So by far, I would say one of the difficult things about like a melting ice cube would be that they issue shares, they do rights offerings, have warrants, they borrow at high interest rates, they do any of those sorts of things, which whether they sell off assets or something to raise cash, which makes it happen much faster. If you have a company that's very successful and always generating some free cash flow, then you're just in a much better position that way long term. Yeah.
And you think it really goes from the industry that they're in as well, which you kind of hit on a little bit earlier. Right?
Yeah.
If it's a retailer versus if it's a service business.
Right. So use the example of a retailer. So a retailer, in terms of your, whether it's a melting ice cube or something, if you very carefully watch net current assets, that would be an indication of if you think that's where the value is.
Like inventory turns and stuff like that?
Well, just literally what is inventory per share, receivables per share, and what are the liabilities offsetting that? And is that number going up or down? I can't tell you how often I see companies, and they still work out sometimes, where they're a net or something, and they actually have declining net current asset value over time. Now, if you buy at a deep enough discount, that can still work out okay for you. But you just have a very clear idea of the appraisal. If you keep appraising the company, and we do this, I mean, I do this all the time, which is that I have an idea of what I think the company's worth, and it's not a share price number, it's some sort of multiple of something else. So it's like if we're talking about a bank or something, it might be, I think it's worth this much in terms of deposits per share because it earns this much in terms of its earnings on those deposits. Or if it's, book value or whatever for something that's like a company that has a lot of real estate or something, it would be based on the number of acres and the price per acre, right? So like we talked about Trinity.
Which is always changing, right?
Yeah, so we talked about like Trinity Place Holdings in a quarterly letter that I did, and we also, I think I mentioned on the podcast or something. So it depended on the average price per condo that it was likely to sell things for in New York. It had once had numbers that, people could have believed it would be $3,000 or more per square foot. And then more recently, it could be that people think it's $2,000 a square foot or worse. Then your appraisal of the company is going to decline by more than 2/3. It would decline by 2/3 before debt and stuff, but condo developers use a lot of debt. So it's a huge decline in terms of your appraisal of the company. So it becomes, a melting ice cube or whatever you would say that way. Or it becomes a value trap in that case. The melting ice cube thing is more like if you're eating up earnings over time. And that's a big thing with I'd say study the history of Buffett's investments.
Yeah.
And Ben Graham too, if you can get them. It's easier to get Buffett. He's better covered. You can actually get Ben Graham things about what Graham Newman owned, like in terms of what positions they owned, and you can go back and find the Moody's manuals and figure out what was happening with these stocks. But there are different kinds of net nets that a lot of people talk about today. They usually were not losing money. So one thing that what Buffett would do is he did not buy into things that consistently lost money. If anything, they usually kind of lost money occasionally or something. There were rare examples. I mean, Berkshire Hathaway is one of the best examples of the worst kind of net he ever bought.
Yeah.
Now, I think he did because they were buying back stock. So they were closing mills and buying back stock. And so doing that, they would liquidate parts of their business and buy back their stock, and he thought they would buy back his stock. And they did offer to buy back his stock.
Yeah.
I think without the stock buybacks, he wouldn't have done it. But that's a good example because just look at what kinds of net nets he actually bought. And the other thing is control investing. So, which is not something that most people listening to this can do. But if you either are able to have some influence or control over the business, that might be a melting ice cube, or you're able to follow on the coattails of someone who has that. An example would be like I invested in Barnes & Noble. At the time, there was a proxy battle with people who weren't the family members who were intending to take the company in a different direction. And when they lost to the founding family there, and the Riggio family decided to invest more in Nook, then I sold out of the business. Whereas if they had, say, really cut down on their investment in Nook and things like that, and had focused on generating a lot of free cash flow or whatever, then it would be different. So it does depend on who's in charge and what their attitudes are.
How much of you think the situation is because of inertia, right? So if I was a technology investor, where technology is always rapidly changing, and there's always, a 12-year-old in their garage trying to compete with you, I would argue that inertia could be what really just destroys like those companies, right? But of course, in the best case scenario, in the way that we invest is obviously we want to invest in companies where inertia is a good thing, right?
Right.
Where it's business as usual. It's kind of been the same thing. The competitive landscape isn't that bad. I mean, you were talking about the one thing that you care most about is predictability and competition, right? But how much do you think companies failing is due to inertia? Like talk about like the real estate. Right. Or real estate, or retailers.
Retailers,
right?
yeah.
I mean, how much of that do you think was okay? Well, we'll try it this way. We'll see if we could, make things work this way, as opposed to adopting other models.
Right. So even using the idea of competition or something, I'd much rather invest in a company in retail. We don't generally own retailers, but I'd much rather invest in a company in retail like Tandy Leather or something, which I think has problems, but I don't think they're generally competitive problems. I think the competitive problems are overstated.
So
I think they're
more so-
operational problems. Yeah. I think that, and there are basic business model issues with it, which I'm not saying isn't a problem. I think that there's some issues about just how profitable the stores can be and whether you can get enough high quality store managers and some other things.
So
like
you're
that.
saying that you'd rather invest in a company that has operating problems
Yes.
as opposed to competition.
Yeah, and in
competitive
retailers,
problems.
like I'd much rather. I mean, Sears was a general retailer, but in general, I would rather invest in more general retailers or in niches that they dominate, like Tandy does, than invest in like specialty retail. Because if you get the specialty retail stuff right, you'll make a ton of money. Yeah. But those are the like nets and things that worry me. So if someone said I have a net that is, let's say Tandy was a net, it isn't right now to my knowledge. It's flirted with being a net at times. It's been pretty close. Then I'd be interested in that because I think that's an operational issue. And there's things that you can see, like how good their gross margins are and their gross profitability, but how poor their operating numbers are sometimes. That gives you an indication that there's stuff that could be cut or that could be improved. Like there, and if you had knowledge, my guess is if you had knowledge, inside knowledge of how the business works and stuff, that you could see what the board sees and stuff, that you would see that some stores perform well and some don't, probably.
Sure.
I don't know that for a fact. But if that's the case, that's a lot more interesting than something that's a chain-wide issue. And so I just think operationally there's stuff that you could turn around there. Same thing if someone said like there's a net supermarket, that would interest me a lot more than certain other kinds of nets. If you told me that there was a company that was in fashion retailer stuff that was a net, that would worry me more because you could make a ton of money if something turns around in the right way for them. But I can't really evaluate that, and it feels like a competitive issue. Mm-hmm. Fashion stuff is a competitive issue about what others are doing versus what you're doing. You want something that, with any of these things, you want something that's within your control. And that's the thing that, like, they'll always have a plan or something, say Sears or something like that. You know, they'll have this plan, but your competitors also have plans. And you want things that are mostly the company that you're looking at can control most of it and are issues that seem solvable within the company versus issues that are going to depend on how competitors react and how you react to those competitors. Mm-hmm. You know, like the Berkshire Hathaway example, they were moving a lot. They had already moved a lot. Of the companies, all their competitors have been moved from like the New England area down to the southern United States where labor is cheaper and some things like that. And the other thing that can happen there is if they cut their prices, then what do you do? Mm-hmm. You know, sure. And you don't want businesses like that.
So you want your price,
so you want businesses that are more insulated from that. Their problem mostly for that kind of company, actually for Berkshire, was CapEx. If other people spend on CapEx, you have to spend on CapEx. You know, so you want to avoid those kinds of things and focus more on ones that, like, you seem like they can control their own destiny the most as possible, which usually means less competition and means operational problems, not competitive problems.
And where price isn't the main competitive, factor, right?
Yeah. Price being the main competitive factor is a problem, but also anything that's sort of, like I said, like fashion type stuff. So take restaurants. If you have restaurants where, if you have a restaurant situation where, like, so a restaurant that you have that could really be a melting ice cube is if you have same store sales going against you for like the first time in the company's history or something. Uh-huh. And what they do is not a very basic kind of thing. Like I was going to write up, we did a huge research and stuff on a company, Greg's in the UK, and didn't come out within time. The stock rebounded a big amount. But what's interesting about it is you could tell that it had the worst operating margin in like 25 years. But Greg's is a very basic kind of company. I don't know what to compare it to in the US except like maybe take Subway and Starbucks and cross them. Like something like that. It's so basic, like we talked about Domino's or Dunkin' Donuts or something, of how that kind of business can be turned around if it runs into problems in a way that if you were telling me I don't know, something like a PF Chang's or something, okay? So if you're telling me that PF Chang's was having problems, I would say, I don't know. It's possible that they could be a good concept that's getting more and more popular for a time and then less popular, and I don't know why. It could be more people coming in and competing with them, doing the same thing, whatever. It's a little more specific what they're doing as opposed to something that's very based on just like speed, price, reliability, those sorts of things.
Well, I think a good actual example that's Jamba Juice. I know they're still public, right? But I remember, that was like, I don't want to call it a fad, but that everyone was pretty big about it. Jamba Juice.
There's lots
and I don't know how the company's doing. I know they are public. I haven't looked at them in a very long time, but I don't think I see the same amount of people that are crazy about Jamba Juice that they were, 15 years ago.
Right, and the problem...
Jeff likes Jamba Juice.
The problem always with those is how many they open. Right, how many they open versus how many competitors can open versus them. That's why things like restaurants and stuff are hard, because usually it's too easy for other people to get into the business. That's a big concern that I have usually when someone says, we talk about this offline all the time, where you'll say like what this business model is and what the predicted returns are on it or what they're earning and stuff. And my concern is always like, yeah, but if it's that easy, what you're like that you can earn back in 3 years after opening a store, then eventually everyone's going to open a store.
Yeah, sure.
You know what I mean? And so you want to find things where for some reason that isn't the case. And those...
What are situations where that's not the case?
Tandy, it's not the case because of scale. So Tandy, the economics of a single store are so, of a single product and stuff are so good, but the volume being done over a single store isn't very much. So they don't earn a ton per store. And then over an entire chain is really surprisingly low considering how big they are. So it's an industry where you need market share of like having half the industry just to be making really good profits. An example that you know too is like Breeze Eastern. So Breeze Eastern, they had like half the market for search and rescue helicopter hoists. And their competitor probably had like a quarter or something, and that might be generous. Like maybe their relative size was even bigger than double. But basically, two companies had most of the market, and if someone else came in, they wouldn't be making money. They just wouldn't even be having enough because of how small the industry was.
Sure.
So that's what I mean about like the things that are scary are the really, really big ones. That's like Sears is a good example of that. The things that are such big industries always worry me because if you're making, they're just, everyone wants to compete in that industry, right? So that's always a concern that like it will attract a lot of competition into that versus something that seems like a fairly small niche. And a lot of times there's a small local niche. That's one of the easiest is like we like microcap stocks and things compared to what most people are looking at. That's more possible that you have a niche of you're only in certain kinds of towns.
Well, it's kind of like Village,
longer that
supermarkets, right?
So it's hard to develop stores around them. It can also be things like you're in small towns. I mean, people have pointed out like, not that we said positive things about or whatever, but there was a thing where people were asking about Hibbett Sports and stuff. Well, Hibbett Sports is in more small towns compared to other things. And I think there's still significant competition from like online and stuff. But it is true they're the last choice of where you'll put a competing store.
Sure.
So the last choice of where you'll put, so it doesn't, if you go to like visit Hibbett Sports and you visit a Dick's Sporting Goods and you're like, well, Dick's is much better, it doesn't matter because the Hibbett is usually in the town that's the last place that Dick's will put it in.
Yeah, sure.
The same sort of thing. Like we've talked about that with other things before where we've said, okay, well, I'd rather have a thing that competes with Dave & Buster or something that's in not Dallas-Fort Worth where we are, which is one of the first places that they'll put the cluster stores around and stuff. I mean, they're actually from around there, but those kinds of places and suburban places like that, higher income suburban, whatever, dense places versus like a little more rural or like a city that's kind of on its own or something, they have more protection from those kinds of things, right? So local's often a really good protection that you have.
Yeah, I remember, and kind of on this topic of competition, when we were in New York and we were staying in New Jersey, or we were on our trip for New York City. We were staying in New Jersey. We went to the boardwalk. I mean, what do you call it? The Jersey Shore? I don't know.
Yeah, it was Jenkinson Boardwalk and Point Pleasant.
There you go.
Yeah.
And we were at an arcade, and we were playing games or whatever, and they had like 3 arcades within like a minute. Like, I mean, literally like just walking, down the boardwalk.
Literally on the boardwalk, yeah.
Yeah, and I was like, why did this happen? I mean, but I guess you get a lot of foot traffic, and maybe there's enough, room for everybody to make money. But I mean, didn't you think that was kind of interesting?
Yeah, it is interesting, but you could see the captive audience that you had, and you were there at a time where there was nobody was there for the beach.
Thank God.
Yeah, but if you're there when people are there for the beach, then obviously you have an audience there that's coming in all the time to play those games and stuff, and there's so little that you put into them. But that same concept, which looks attractive, so if you had something, say that something was wrong with that business, it's a private business, we don't know anything about it, but say that you have something that's on the boardwalk in New Jersey there, that's an arcade, and it runs into problems, I'd be very interested in that. That would be one of the first things I would look at, be really
because
excited
like an
about.
operating thing.
It
right?
seems like it's an operating issue, not a competitive issue.
Geoff has always said that and I swear I was so surprised by it. I asked him probably 2.5 years ago, and it's always stuck with me. If he were to start a business on his own, what would it be? Here I am thinking, okay, this guy's looked at trillions of companies over the years.
Yeah.
He's going to come up with some just perfect thing. And he said an arcade. And I was surprised by it. But it makes a lot of sense, right? Especially when we were at this arcade. I was, kind of doing my own little scuttlebutt and just looking around. I was like, wow, I don't think there's anyone over 16 years old that's working here and probably making, minimum wage. And it's like the easiest thing in the world.
Yep.
Right?
And they eventually converted it to the, they put some tech CapEx into that one. They have waited forever to do that.
Yeah.
So before then they had, needed more labor. So they cut down on labor by doing that. But it's just the margins on that stuff, right? So what the gross margins are on that. And that place wasn't even one that sold food and beverage or any of that stuff. That also
they had free pizza. I did see the free pizza.
Yeah.
I did look at it. I didn't have a piece. Free pizza and coffee, which I thought was interesting. But no, I mean, even looking at it, and you can make the argument. So I guess talking about like melting ice cubes, right, and value traps. People would be like, oh, well, do kids even want to play arcades anymore? Blah blah blah. But you got iPads and all this other stimulus and YouTube and kids watching other kids play video games. It's crazy. But I don't think arcades are going to go away. Like, there's just something like special about actually doing it in person. It's like one of those things,
Yeah, but I do think that you can have, and we talked about this with like gyms and things. Same thing. I think you can have something that becomes a bigger and bigger part of the society, and the industry can do okay. And yet you can be looking at a company that's losing money over time, that is getting worse off because their same store sales are getting worse. And the reason for that would be competition. So like we were talking about the arcade thing, if it's an arcade on the boardwalk there and it's having problems, I'd be very interested. Yeah. But if it's an arcade in a town where it was the only arcade there at first and now there are 3 there and that's why the returns have gone down, that's the kind of thing that worries me. So it's always the competition aspect of it. I always get worried about when people talk about these value traps and things where it's continually more and more competition is the fear, right? So that like we were looking at something where basically a technology company and we talked to some people who are knowledgeable about the technology, and basically what they're saying is it's gotten cheaper and cheaper to basically take things almost off the shelf. You can put it together yourself. It's a total commodity. You assemble it yourself and can duplicate what used to be a lot of effort on their part, what like 10 years ago was a pretty big sort of thing that had to be done by a major technology company, is now something that you can almost do at home using products that are consumer grade type products, right, to do the same things. If you're knowledgeable about artificial intelligence, which sure most people aren't, but you don't need a lot of people who are knowledgeable about artificial intelligence.
Not a lot of people have a PhD in machine learning. Right?
But if you have a small group of people who have that, okay, and a bunch of companies could get that without any trouble, then you have a small team of people who can do that. You don't need very impressive products to be able to do that. Whereas you used to need all sorts of time and computing power and all sorts of things that they needed before. And so that kind of thing really worries me, as opposed to this industry is declining a lot. Yeah. The other thing that worries me is that there's no value add thing. So those seem to decline really, really quickly. So there have been a couple companies that I've avoided. I don't want to say even for ethical reasons or something. People think it's for ethical reasons, but it's more like the way in which the product was sold and stuff was strange. So
like what?
So an example would be there was one company that had fine-looking financial stuff, but we did not write up for the newsletter because we looked at it. Which
was it an MLM?
No, but there are some that are. There are some. That's the other reason for avoiding them. But it was a company that did. It was doing financial services by basically doing like debit cards for colleges, where the students hated the debit cards, but because of the way the deal was structured, the colleges loved it.
Okay, what company was this?
So the colleges. I think it was eventually named Hire One. Okay. So the way that it was structured, you could tell was very attractive to the college, and the students were kind of captive audience, captive market there. Forced. And they would be like charged pretty high fees, so they end up with like paying $5 fees and stuff all the time. And it was clear the customer service stuff was very poor on that. They were very dissatisfied with it, whatever. And yet, because of the way it was set up, they originally got this business with the colleges. But just looking at it, it worried me that they weren't happy about it, and that they were essentially the customers that you needed, and that what they were doing wasn't really adding value. That also worries me about the company that we were just mentioning, which is Searance, which is the one that was the spin-off and is doing something that I think has gotten kind of basic and commoditized. Their sales process and everything could be fine.
If you know anything about Searance, email me, info@focuscompounding.com.
Okay. So car makers and stuff could still like this for a bunch of different reasons, almost as if they're like consulting with them on a project that's useful, even though the thing they're doing is now pretty basic. But it still worries me because I'm not sure that the thing they're doing actually adds that much value anymore. Whereas when we invest in companies, even like take NACA or something, which is declining over time, coal mining in terms of its use as fuel in utilities, right? So that's declining. But to the utilities or to whoever else is using them to mine, do mining as a service, right? Which is how they talk about it. They have the entire, they do everything for them. It's still a big value add to take over all of that mine and do that thing for them. And that kind of thing is very valuable in a way that I don't worry as much about. Same thing when people talk to me about like ad agencies and they're like, they've had a very hard time growing over time and stuff. It's not something I worry about as being a value trap if you buy it at a really cheap price. Yeah. Because I do think that they add a ton of value still in those cases. And I think they have relatively little competition in the sense that you don't like to switch them that much. So same sort of thing. So it's a situation where I think you could have like no revenue growth for a long time, but it's not something where I worry about it becoming Sears. I don't worry about any big ad agency being like any big department store. I'd be way more worried about big department stores than big ad agencies.
Do you think a lot of it too is, I guess, like if the experience component of it for the customer? So like we were talking about like arcades and stuff like that, and like I guess their competition is what? I mean, iPads and I guess like all that other stuff that little kids play on.
They
nowadays.
Claim it is.
I'm
not sure that it is.
Yeah, but I mean, but my point is though, like people still value like the experience. I think of going and playing in these arcades, and then you get the tickets, and then you get to you pay pretty much like $50 to play to buy like $2 in candy, right?
Yeah,
that's why it's great business, right? Or it's even like going to theme parks or like Six Flags. Like people value like that actual experience of going out. It's very much experience based as opposed to like Kodak, for example. It's the new technology was just better. So you had a better experience with it.
Right, yeah. And I think you are touching something true that's true, which is like the more ephemeral it is, the more that it's hard to tell what to put a dollar value on what you're getting out of it. Yeah. Which is always the hard thing about a retailer, because retailers always say that they give you this experience that, going to Neiman Marcus.
You could say the same thing about Radio Shack, right? You go, you're a technology buff, whatever, you enjoy to go there, and then you walk into this place, they have just everything you could possibly need to like build computers and stuff like that, right?
Yeah. And for some people, it's a really special experience that way. But for other people, it's a very basic sort of commodity type thing that they're getting out of it, you know? And I think that happens a lot. The retailers tend to
like
get
that
very
company. I could see how Amazon or these other one-off retailers or whatever could hurt Radio Shack. Maybe Amazon, like Newegg or whatever. It's all incredibly cheap.
Yeah, exactly. And those sorts of things were hurt first by it. Yeah.
But like an arcade, other type of theme park attractions, stuff like that, where it's very much experience based.
Yeah, absolutely. I agree with that. That's a hard thing to. I mean, there's lots of things where people say the technology. I mean, there's so many cases where people say the technology thing is going to devastate that industry, and it doesn't. Yeah. I've mentioned this many times before, but it was literally something that people talked about and were worried about with supermarkets when I invested in them in like 2000, 1999. So we're talking about 20 years that people said that online groceries in the U.S. were going to be a big deal for supermarkets. Supermarkets barely notice it to this day. They do some things with it. They compete with something.
Well, it's
barely noticeable.
They didn't really have inertia, right? Now they all have their own version of like some pickup or stuff like that.
They're all trying to do it. Yeah. They're kind of trying to force it on the customers, whether the customers want it or not.
I don't think customers want it. I don't know.
I don't know the answer to that, but it's been something that people believe would happen for a long time and hasn't happened. Whereas in other cases, things like say newspapers or something, that changed overnight. But some of that is understanding the business too, because like newspapers, right? A big part of it is understanding classifieds. So if you didn't understand how quickly all classified stuff went online, basically, that all the business that had been classified, which is a big part of their business, like instantly went online. That's something that, where there was originally Craigslist and stuff, or now it's Facebook and on top of all those sorts of things, like ways of finding things in your local area of, I have this thing to sell and that kind of stuff went immediately and was a really big part of their business. And so that kind of changed things in a huge way. But you have to understand what the value is that they're adding. Some of the newspaper thing was just like being a bulletin board. It's not a special thing that they're serving. It's just a way of, getting people in communication with each other.
Well, if I lived in New York City, I certainly would like my groceries delivered to me, because I don't think I saw any sort of
it makes a ton of sense in cities and in rural areas, but in suburban areas, it's really hard to compete with a big supermarket. A 60, 70, 80,000 square foot supermarket shopping on your own there, that's tough to compete with by online. It's very hard to come up with a model that makes sense.
Got it. Well, that is the end of today's podcast. I want to thank everybody so much for tuning in with Mr. Geoff and myself. If this is the first time that you are checking with us, be sure to hit that subscribe button, thumbs this video up, leave us a rating review. That goes a very long way with us, and we are certainly appreciative of anything any way that people support us. Also, if you want to check out all of our other work as well, be sure to go to focuscompounding.com. And if you want to sign up, use the podcast promo code, which is podcast, and that will take $10 off of the subscription price, bring it from $60 a month to $50 a month. Geoff is going to write like a madman, 250 plus different ideas this year. And we already have over 100 different ideas on the website as well. So it's a small community of investors that invest in overlooked stocks. So definitely if you want to join us, check us out there. I want to thank everybody so much for tuning in with us. We'll see you in the next podcast. Take care. Hey, this is Andrew Kuhn, and that was the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along.